Hello and welcome back to Accounting 201. I'm your host, Dr. B. Uh, we are going to be discussing liabilities and bonds payable today, and we'll also be covering stocks as well. Stocks and bonds is a way for companies to raise capital. That is the idea behind issuing stocks and bonds. As you know, capital is money, right? The idea behind companies issuing stocks and bonds is to raise money. And what do they do with that money? They grow, they invest in the company. That's the idea. That's the idea behind it. We do not get too deep into stocks and bonds in this course. We do discuss them. We talk about how to account for them, but we're not going to get too deep into stocks and bonds because this is an accounting course. It's not a finance course. But we will definitely cover those things. Kator, do you have a question?
No, sorry.
Okay, that's okay. That's all right. No worries. As I mentioned before, if you do have a question, please feel free to unmute yourself and ask your question, and I'll be happy to answer it for you. Quick housekeeping notes, just as we get started. We are currently in week 6 of our 8-week course. Some of you may wonder, we cover a lot of content in this course and we only meet once a week. Why is that? Well, since the course has been designed for an online format and all the videos are recorded, and I do have regular office hours, and you're more than welcome to meet with me during those office hours, or even send me an email or call me. You have multiple ways of getting hold of me. So if you ever have a question, you ever need help, please get a hold of me. I'll be happy to help you. So we're in week 6. What does that mean? There's only 8 weeks in the course. Today we're covering chapters 11 and 12. Next week will be 13 and 14, and we're done after that, right? Week 8 is the final exam. So if you're behind, if you're missing work, if you want to retake any of your homework or your quizzes, do that for sure to get a higher grade. As you know, you need a C or a higher to pass this course. A C or higher to pass this course. That was explicitly mentioned in the syllabus. We talked about that on the first day. So that means you need a 70 or higher to pass the course. If you currently have a 0 on any of your stuff, that's 5% of your grade that you're missing, right? So take that. You need to make sure that you do all the work in this course. That's how you pass. That's the only way you'll pass, is to do the work. If you don't do the work, you don't pass. It's very simple. There's 2 assignments every week. There has been and there will be. For those of you who are continuing on with me into 202, it's designed the same exact way. We meet on Tuesdays. There are 2 assignments every week. Why is that? It's 8 weeks. If it was a 16-week course, it would be 1 chapter a week, but it's not. This is an 8-week course. And so 202 is the same way. So if that's not for you, or if you don't think you could handle it, definitely speak to your advisor. But hopefully you can. I want you to stay in the course, right? And I want you to do well, and I'm here to support you. I just want you to understand that the way that this course is formatted, it's the same exact format in 202. And that's the way 8-week courses are designed. It's condensed. It's definitely quite a bit of work. Go ahead, Phil.
Is your 202 course, is it already full?
No, it's not. At least it shouldn't be anyway. But I do think that enrollment's closed. But you might want to check with your advisor.
Okay, because it wouldn't allow me to register for that course because this was like a prerequisite.
That's right. Yep. That's correct. But it should have allowed you to. It should have allowed you to. So yeah, check with your advisor, and and if they can't help you, I will. So just go ahead and send me an email as well.
Thank you.
Yep. Richard said it needed to be a manual register. That's right. So yeah, definitely reach out to your advisor. It might be able to still get you in, hopefully. If not, then it'll be available again in the next semester. Either way, we'll get you through it. Okay, good point. Great. So what does that mean? We have chapters 11 and 12 assignments, and then we'll have 13 and 14, then that's it. We're done. So please, if you're missing anything, you need to make sure you get that done. The only way to pass this course is to do the work. And you really should try to do it on time whenever you can, yes? That's really the only way you'll be able to stay on top of this course. I did also mention that accounting is a practice. It's a practice. Just like a lawyer practices, an accountant practices. Just like a dentist is a practice, accounting is a practice. Just like, right? The idea behind the word practice is that you continually do the work. That in accounting, we learn by doing. Learn by doing. That's how you'll get through the course. So, okay. I'm sorry, I got on my soapbox. Are there any questions before we proceed to chapter 11? We're good? Okay, wonderful. Just as before, I'll give you some examples. We'll have some conversations around the concepts. And if you have questions, please feel free to unmute yourself. I'll be happy to answer. All right, let's rock and roll. Perfecto. Okay. So let's talk about bonds. We're going to talk about bonds. We're going to talk about stocks. A bond. A bond is very similar to a loan. A bond is very similar to a loan. It has the same exact types of elements. It's an interest-bearing note, just like a loan is. A bond requires periodic payments, just like a loan. And it has a face amount that needs to be repaid at the maturity date, just like a loan. Okay, so let's break down these elements. Interest bearing, that means interest rate. You have to pay interest on a bond. It requires regular payments, whether that be monthly or quarterly. A bond makes the same amount regular payments. So just like you regularly pay your rent or your mortgage, a bond works the same exact way. It's the same amount every single month, first of the month. It works the same exact way. It has a face amount need to be repaid at the maturity date. What does that mean? A face amount is the bond amount. It's like the amount that you see on a check. It's the same concept. That's what they call the face amount. They call it the face amount because it is the total amount on the check. That's called face amount. Okay? And that amount needs to be repaid at the maturity date. Maturity date means when it's due. When it's due. That's what maturity date means, when it's due. Okay, so the way it works is with a bond is bonds will pay out regular interest payments. Okay, so it's interest only. So if you took out a bond for $100 and it had a 10% interest associated with it, and it was for 10 months, you'd make $1 interest payment every month, right? And then at the end of that 10 months, that's when you pay the 100. That's the idea behind it. So that's where it's different from a loan. I said a bond is similar to a loan, but it's not quite a loan. With a loan, you make the interest plus principal. But with a bond, you make interest only, and at the end of the bond, at the due date or maturity date, that's when you pay the face amount. Does that make sense? I want you to understand.
Yes.
Great, thanks, Mike. I just want you to understand the basics of a bond. So as creditors of the corporation, bondholders' claims corporation's asset rank ahead of stockholders. Ooh, what does that mean? Okay. So a creditor, a creditor of the corporation, meaning somebody who holds the bond, they have first dibs over stockholders. In other words, the bondholders, they'll get paid first before the stockholders will. That's what that means. Okay, here's an example. So bond issue is normally divided into a number of individual bonds. In other words, let's say the company issues a $100,000 bond, okay? The company will typically issue a series of bonds. These are small bonds, okay? So instead of like a $100,000 bond, which is a lot of money, they'll issue a couple of $1,000 bonds. They'll issue $101,000 bonds instead of a large $100,000 bond. The reason for that is because they're able to raise more capital by dividing it out. So the face amount of each bond is called the principal amount. These are usually in $1,000 increments. The principal needs to be repaid at the bond's maturity date. The bond maturity date is when the bond is due. Interest on the bonds can be paid annually, semi-annually, or quarterly, sometimes even monthly. But annual, semi-annual, or quarterly interest payments on bonds. Now remember, the interest payment is interest only, does not include any principal. The principal is only paid at the bond maturity date, not throughout the bond's life. The principal is only paid at the bond maturity date, not throughout the bond's life. Interest-only payments are made throughout the bond's life. Most bonds pay interest semi-annually. Yeah, but it's also very common to see bonds pay out quarterly as well. Underlying contracts between the company issuing the bond and the bond holders is called a bond indenture. The way to think about a bond indenture is like thinking about a contract. It's a contract. It's an agreement between the company and the bondholder. It's what do you call? What is that called when you take out a loan and it's called a promissory note, right? Promissory note. A bond indenture is very similar to a promissory note. It's another way to think of it. Two most common types of bonds are called term bonds and serial bonds. Yes, please.
I have a question.
Go ahead.
So
Regina.
is the promissory note like a letter saying that this is the loan you took out, this is the amount that you're going to pay back to them?
That's right. Yep. It's a promissory note is a contract between you and the bank, and it's basically a promising that you're going to pay back that loan, and it usually tells you how long it'll take you to pay it back, what the payment amounts are, when it's due, all that good stuff. Yeah, exactly. And for those of you who had to take out student loans, you probably also had to sign a promissory note as well. Good, great question. Absolutely, Regina. That's right. So two most common types of bonds are term bonds and serial bonds. Term bonds are bonds that issue and mature at the same time. Issue and mature at the same time. That's called a term bond. In other words, I'm sorry, when all bonds of an issue mature at the same time. So that's called a term bond. A term bond, what it means is all the bonds that are issued within that group of bonds, they all mature on the same day. Okay, so an example would be I issued $100,000 of bonds at $10,000 increments. Okay, so that means I issued 10 total bonds, right? 10 times 100. So if I issued 10 total bonds, all of those bonds, those 10 bonds, are due on the same day. That makes it a term bond. When all the bonds are due at the same day. Term bond. The other type of bond is called a serial bond. A serial bond are bonds that mature over several different due dates. Several different dates. Serial bond mature over several different due dates. Example. I issued a bond for $100,000 at $10,000 increments. That means I issued 10 total bonds. These bonds were classified as being serial. If you think of the word serial, it means it's like, think of serial number. Serial number. A serial number is the number on the check, right? And that number on the check goes in sequence. Sequence. The word serial and sequence. That's the relationship you want to make. The word serial and sequence. It goes in sequential order. So what does that mean? If I issued a bond of $10,000 in increments of 10,000, that means I issued 10 bonds. Those 10 bonds, one will mature in 30 days, another one will mature in another 30, another one will mature in 60, another one will mature in 90, so forth and so on. That makes it a serial bond. They have multiple due dates instead of them all becoming due at the same time. So those are the two different types of bonds. Of course, there are more complicated bond structures. We're not going to get too deep into them, but they're good to know. Other types of bond, another type of bond is called a convertible bond. Convertible bond. These are bonds that can be exchanged for shares of common stock. So if I issued a bond for $10,000 and the bondholder came to me and said, you know what? Instead of this bond for $10,000, I want $10,000 worth of common stock in your company. That would be then called a convertible bond. It's called a convertible bond because we're converting it from a bond to shares of common stock. And another type of bond are called callable bonds. Callable bonds. Word callable means it can be redeemed prior to the maturity date. Callable. When you call something, you're taking it into your possession. You're calling it. You're calling it to you. You're calling it to you. Callable means you can redeem it before maturity. Okay? It's kind of like paying back a loan before it's actually due. That would be a callable loan, right? That's the idea behind it, is that you can redeem it before it's actually due. Callable. Okay. Let's talk about how bonds are issued and what comes from those bonds. So when a corporation issues bonds, proceeds received from the bonds depends on the face value, when the bond matures, the interest rate, and the market rate of similar bonds. The word proceeds means the cash received. Proceeds. Proceeds, you know. It's the cash coming in. The proceeds. Okay? So the proceeds are the cash that the corporation's getting in from the issuance of those bonds. And the amount of cash that the company gets in from the issuance of those bonds depends on how much the bond was issued for, face amount. When is the maturity date? The interest rate associated with that bond, and the market rate of similar bonds. The market rate of similar bonds is the market rate of interest of similar bonds is like saying, oh, you know, my mortgage was at 2.5%, and right now the market rate is at 2.7%. Okay. That's comparing different interest rates based on market factors. Okay, and that is a factor of how much proceeds the company will get, because some bonds use the market rate as what we call a peg. A peg is where we tie the interest rate of the bond to the market rate. We'll talk more about that. The face amount and the interest rate on bonds are identified in that document we call the bond indenture. Remember, the bond indenture is very similar to a promissory note. It includes things like the face value, maturity date, interest rate, market rate, all of that good stuff. Think of a bond indenture similar to like a promissory note. The interest rate to be paid on the face amount is called the contract rate or coupon rate. It's mostly called contract rate. Contract rate is the amount of interest, or the rate of interest that is agreed upon between the corporation and the bondholder. Let's talk about market rates. Now, one thing I'll say, especially about bonds and other types of notes, the market rate is typically always different than the actual rate. For example, you bought a house and the interest rate on your mortgage is 2.6%. The market rate was 2.5% at the time. The reason why it's different is because of factors, market factors. The factors would be things like your credit score, credit history, amount being financed, the interest rate from the bank. All of that determines the interest rate for your mortgage, which is going to be different than the market rate. The market rate is based off of market factors or market conditions, which is different than your personal finance conditions, right? So market rate of interest is sometimes called the effective rate of interest, which is determined from sales and purchases of similar bonds. That's why, like, you know, if you ever listen to somebody say, oh, you know, the interest rate on mortgages is currently at 3%, and then the next day, oh, it went up to 3.1%. Oh, and the next day, oh, it went up to 3.5%, and then the next day, oh, it went down to 2.9%, and that's the market rate of mortgages. The market rate of mortgages. It works the same way. It goes up and down every single day. And it's based off of market factors. What drives interest rates up and down, you might ask? It depends on the economic conditions. The economic conditions dictate what happens to the market rate. For example, if market conditions are bad, meaning high unemployment, low inflation, possibly deflation, things are slow, GDP is slow, those are not favorable market conditions, and those drive interest rates down, which is what we're seeing in today's market environment. We see that mortgage rates are the lowest they've ever been, or very close to the lowest they've ever been. We see that getting a loan is a lot easier, and the interest rates are the lowest they've been in recent times. The reason for this is because the market is not doing well. The natural economy is not doing well. During good economic times, we see the interest rate, the market rate, increase, okay? Which is what we saw back in the 2015 to 2019. We saw that also in the early 2000s. We saw that in the late 90s. And before that in the 80s. Well, back then the markets were doing very well. The economic conditions were doing very well. Unemployment was low. Inflation was high, which drove up interest rates. So market conditions and economic conditions are the reasons why we see interest rates fluctuating every single day. Comparing the market and contract interest rates can be determined whether the bond will sell for more than or less than its face amount. Think of it this way. The value of something, the value of your house, okay, your car, the value of your car or your house goes up and it goes down. And this is based off of economic conditions. Call it the market rate. The contract rate is, again, the agreement of the interest rate between the company and the bondholders. That contract rate will either be higher or lower than the market rate. It will either be higher or lower than the market rate. And again, the reason for that is the change in the market rate on a regular basis. We know that the contract rate will not change. Once it's locked in, that's the contract rate. The market will continue to go up and down, regardless of what happens to the contract rate. Therefore, the bonds will sell for either more than or less than their face amount. We call it either a premium or a discount, and we'll talk about that. The face amount is where the market rate equals the contract rate. The face amount is where the market rate equals the contract rate. But we also know that it's rare that the two will be equal. Go ahead, David.
Professor?
Yeah, David, go ahead.
I said, can you explain that a little bit better?
Sure. So, with a bond, the bond will have a face amount, face value.
Right.
The face value in the contract rate, or I'm sorry, the face value in the contract rate is, that's the amount that's agreed upon between the bondholder and the corporation.
Right.
The market rate changes every single day.
Right. I understand that.
So when in time the market rate equals the contract rate, the bond will sell to the bondholder at the face amount.
Okay.
It's when the market rate is the same as the contract rate, the bond will sell at the face amount.
Okay.
But there's a good chance that
So
the market rate,
so the market is under the contract rate. If the
right,
market is under, they wouldn't sell.
it'll still sell, but it'll sell for higher than the face value.
Okay, to sell higher. Okay, so but then and if it's okay, it'll sell lower.
Exactly. And that's what happens is the buyer will either get the bond at a discount rate or they'll get it at a premium rate. And so the way it works is that if the market rate is higher than the contract rate, that's when the bond will sell for less than its face value. When it sells for less than its face value, we call that a discount rate. And then, of course, the opposite is also true. When the market rate is less than the contract rate, the bond will sell at a premium because the market is lower than the contract.
Right.
Does that make sense?
Yeah.
Perfect. Sounds good. Wonderful. Thanks for the question. I appreciate that. The price of the bond is quoted as a percentage of the bond's face value. The price of the bond is quoted as a percentage of the bond's face value. Okay. So why do we as accountants care about market rates and discount and premium? Why do we care? Well, because if we're the accountant for the company, we need to account for the issuance of those bonds, when they're issued, what's the interest rate, when will it be paid back. So when bonds are issued at less than or more than the face value of the amount, the discount or the premium will be amortized over the life of the bonds. At the maturity date, the face amount must be repaid. We know that because that's how bonds work. So remember, the interest is what we pay through the life of the bond. The face value is what gets repaid at the maturity date of the bond. When a bond is issued at face amount, meaning the contract rate and the the contract rate and the market rate are the same, the bond will sell at their face amount, just like we talked about. If the bond is issued at a discount, the contract rate is less than the market rate, meaning discount, right? The bond will sell at less than its face amount. We call this the carrying amount of bonds payable is the face amount of the bonds less any amortized discount plus any unamortized premium. The word amortization, as we talked about in earlier chapters, the word amortization is the allocation of interest over the life of the bond. And there's a couple of different ways of amortizing, and we're going to talk about that. Every period, a portion of the bond discount must be reduced and added to the interest expense to reflect the passage of time. Well, does that sound familiar? Do you all remember when we talked about depreciation? I'm sure you guys remember that. Wasn't that last week? Week before? I forget. The passage of time, right? Okay, so we talked about this thing called depreciation in previous chapters. With depreciation, we talked about straight line, double declining balance, units, right? I'm pretty sure we talked about those things. And when we talked about those things, I want you to remember how we did that and think about the similarity to amortization, because it's very, very similar in concept. The way to think about it, with depreciation, remember when we recorded depreciation, we had to debit depreciation expense and credit accumulated depreciation. Well, the same concept works for amortizing a bond. We debit amortization, we debit the amortization expense and credit accumulated amortization. Same concept, right? So this process called amortization. It increases the contract rate of the interest on a bond to the market rate of interest that existed at the date the bonds were issued. So again, amortization works very similarly to depreciation. Amortization, depreciation, very, very similar. They work the same way. So there's two methods of computing amortization of a bond discount. One is by the straight line method. You all remember straight line method. It's the same concept. We'll talk about it. And the second method of computing amortization on a discount bond is the effective interest rate method, which is also called the interest method. We'll talk about it. So the effective interest rate method is required by generally accepted accounting principles. However, the straight line method may be used if the results do not differ significantly from the effective interest rate. Straight line method of amortization provides equal amounts of discount or premium to be written off to interest expense each period. So it works the same way as depreciation does. Amortization and depreciation are very, very similar. Remember, with straight line method, we depreciate or amortize in this case the same amount over every single period. So we debit interest expense, credit accumulated amortization, right? The same exact method. The effect of the discount amortization is to increase the interest expense on every semi-annual interest payment made. So essentially what's happening is this increases the contract rate of interest to the rate of interest that approximates the market rate. What does that mean? In other words, as we amortize, we stop amortizing when the contract rate equals the market rate. As the discount is amortized, the carrying amount of the bonds increase until it equals the face amount on the bonds on the maturity date. So that was a discount. Any questions on bonds issued at a discount before we jump into bonds issued at a premium? It makes relative sense, right? It's very similar to loans, very similar. They act in a very similar way. It's very similar to the concept of depreciation when we talk about amortization. The concepts are really similar. Okay, so let's talk about bonds issued at a premium. When the contract rate is higher than the market rate, bonds will sell for more than their face amount. That seems to happen a lot around here, especially when we talk about the housing market, but it works the same way. So very similar to bond discounts, the bond premium is also amortized over the life of the bond. The amortization of a bond premium decreases the contract rate of interest on a bond to the market rate of interest that existed at the date of issuance. In other words, we amortize until the bond rate equals market rate. The effect of the premium amortization is to decrease the interest expense on every semi-annual interest payment. In effect, this increases the contract rate of interest that approximates the market rate. Again, once the interest rate on the bond premium equals the market rate, that's when we stop amortizing. And that is also at the same time that the face value is due. Okay, so we talked about bond discounts, we talked about bond premiums. Those were the two most common bond issuance. Now let's talk about bond redemption. Bond redemption is when we call the bond before it matures. Remember I said a bond can be what we call callable. When you call it, that means you're redeeming it. Okay, you're taking it back or you're paying it back before it matures. Okay. This is done when the market rate declines below the contract rate to prevent a loss or to prevent a discount from happening. So, for example, a company will typically repurchase its stock before the stock declines, right? The reason for that is to maintain its value. The same concept applies with bonds. The bonds can be recalled prior to the maturity date if they notice that the market rate declines below the contract rate. The idea behind that is to protect from having to pay at a discount. Because the idea is nobody likes to lose money. So in order to not lose money, you want to call it before the market rate dips below the contract rate.
Hey, Professor.
Go ahead, David.
So say, okay, so like you said they call them in. So that mean like the people that actually holds the bonds, they return them to the bank?
To the corporation, yeah. So, or the person who holds the bond is the one that owns the bond, right?
Right.
That person can call the bond, meaning they were like, hey, listen, I bought this bond from you. I want you to repay me now instead of at the maturity date because the market rate is going to dip below the contract rate.
Right.
And the reason why they do that is because the bank, they don't want to lose money, right? They want to make sure that they gain that premium on the bond. Does that make sense?
Yeah. Yeah.
It's kind of like so a bank has the same ability. A bank can call a loan. Okay, when a bank calls a loan, what that means is the loan holder needs to repay that loan to the bank right then and there. Okay, and the reason why a bank might call a loan is because the bank doesn't want to lose out on the premium interest rate
That
before
they
the
will
interest rate goes down.
Okay.
And that's common with adjustable rates.
But what if you can't return that loan?
Well, that happens from time to time. Then typically you'll have to refinance when that happens.
Okay.
Yeah, that does happen from time to time. But don't make sure you never get put in that position.
Yeah, because I said that like if say like you I take out a business loan and the bank calls back the loan, but the loan is in the process of You know,
The bank could shut you down. Yeah. So and so you have to be really careful when that happens. I've seen that happen once, a few times before, actually.
company.
So yeah. So what happened is I was doing some consulting work with this guy who owned a real estate company. And
Right.
what he did is he bought a bunch of properties, buying and selling, right? Flipping them.
Right. Right.
And so what happened is this guy was buying and selling houses, he was flipping them, and the bank caught wind of what he was doing. The bank was not happy, so the bank decided to call his loans. So
But
the bank,
like, what do they think? I mean, like, if a bank gives someone a loan, isn't that the reason for them giving them the loan is for them to flip it and make money and then pay them their interest and everybody be happy?
not if you don't tell the bank that's what you're doing.
Oh, okay.
Yeah, and moreover, you have to think of it this way: a loan is a risk that the bank is taking.
Right.
Okay, it's like all right, David. So let's say I want to invest in David. I'm going to be like, you know what? I'm going to give David $1 million, and I'm going to say, hey, David, here's $1 million. Pay me back $1.2 million, in 30 years. Okay, and you're like, great. So what do? You buy the properties, you flip them, and then I, as the bank, I'm like, you know what? I issued this guy so many different loans, adding up to 1.2 million, and it's just too risky. It's just too risky. So the bank realizes it's too risky for the bank. That's when the bank goes, I'm going to call the loans. And so what happens to the person that is holding those loans is they go bankrupt, or or they simply refinance. But just make sure that every
And
loan that you take,
when you say refinance, you just renegotiate the interest rate.
more than that, it's like when you refinance, you're basically, what you're doing is you're saying, hey, listen, lock me in at this interest rate, and I'll pay you this amount to do that, or I'll put up this kind of collateral to do that.
Right. It's like
Kind
it's restarting the contract.
of like restarting the contract. That's right, exactly. And so that's the best way around that type of situation. But my advice is, don't ever get caught short-handed. It's it. Don't let read the contract very carefully.
Because
It's like,
they have to put that in the
oh
contract if
yeah,
they
absolutely, absolutely. And in most contracts, that is the case. Like when you read through a contract, there's usually a disclosure in there that'll say, this loan is callable based off of these factors, and it'll be very, very clear. That's why
right.
that's why a lot of times it's good to get a lawyer to read over those types of contracts. Yeah,
Right.
great question. Good question. Good conversation. So callable bonds can be redeemed by issuing the corporation within a period of time, and at the price stated in the bond indenture. In other words, the bond still needs to be repaid at that face value. When a bond is callable, it's usually above the face value. It's usually above the face value. So, in other words, you're not just going to pay the face value back. You're going to pay the face value plus whatever interest rate was stated. Corporation usually redeems its bonds at a price that's different from the carrying amount, or also known as the book value, of those bonds. A gain or a loss may be realized on a bond redemption. A gain is recorded if the price paid for the redemption is below the carrying amount, and a loss is recorded if the price paid for the redemption is above the carrying amount. You already know how to record gains and losses. We talked about that when we talked about the sale of fixed assets. Remember? That was some time ago as well. Gains and losses on the redemption of bonds are reported in the other revenue or expenses on the income statement, just like when we would sell a fixed asset. All right, what about the reporting? Bonds payable are reported as liabilities on the balance sheet. Remember, any type of payable is going to be a current liability on the balance sheet. Any portion that is due within 1 year is current, and the remainder is long-term. Greater than 1 year, long-term. Less than 1 year, current. Any amortized premium is recorded as an addition to the face value of the bond. Any unamortized discount is reported as a reduction on the face value of the bond. A description of the bond should always be included on the report, either as on the face of the financial statements or in accompanying notes. Earlier, I mentioned that publicly traded companies are required to report their financial statements through the 10-K document through the Securities Exchange Commission. All publicly traded companies are required to disclose all of their financial statements through the Securities Exchange Commission. In the notes of those financial statements, you will find descriptions of bonds that the company may have issued. Oh my, a ratio. I know you guys love these ratios, don't you? Oh, I know you do. Okay, we as managers need to understand how to make decisions based off of these types of things like bonds. And a lot of these types of ratios are things that I would compute when I'm investing in a company. This one's called the times interest earned. Analysts, like myself, assess the risk that bondholders will not receive their interest payment. In other words, if I hold a bond for a company, I want to make sure I'm going to get my interest. I'm not going to take out no bond with a company that's not going to pay me interest. That's silly. So how do I calculate the risk of the company not being able to pay the interest? We call it the times interest earned ratio. Times interest earned ratio, we take the income before income tax, found on the income statement, toward the bottom, plus interest expense, found on the income statement near the bottom, divided by income expense, also known as operating expenses. This ratio computes the number of times interest payments could be paid out of the current period earnings. In other words, how many times can the company pay their interest payments during the year? Okay. High values of the ratio are considered favorable. The more that they're able to pay interest throughout the year, the better. However, if it's less than 1, that's not so good. That means they won't be able to pay interest payments throughout the year. And that is the conclusion of bonds payable. Any questions on bonds? Any questions on bonds? Before we move into stocks, another fun topic. We're good on bonds? Okay. I'm going to stop the recording for bonds, and I will start a new recording for stocks. Stand by.